Hello and welcome to another episode of Frugal Finance. This is the update for the midweek pie. Unfortunately, the pie is dead. It is over. The relationship has gone. Caputo. We're divorced. We are no longer married at the hip. Whatever way you want to look at it. Moment silence, please, for the pie. Hang on a minute, we have still got a pie, but it's not a dividend pie. Right, let me explain. So basically, I discovered from doing my own research with the dividend pie, I had the daily dividend pie running before, which obviously, to be fair, was a pretty good pie. It did actually perform pretty well. It's just that it didn't really give me what I kind of wanted back from my portfolio. It was very nice having a daily pie and or almost daily, as the pie owner puts in brackets. The issue that I had is that because these companies are quite well established companies, and they essentially, that's why they are dividend growth companies, because they're not really innovating their company. So what they're doing is they're giving shareholding or profit back to its shareholders. I mean, say for the sake of Apple, for example, and the real estate ones, most of these companies are got pretty stagnant growth. So actually, you're only going to get about 1 or 2%, which is what I was finding, in terms of a return. Now, you're getting about 1% in dividends off of whatever money you had in there. And I had a fair chunk. I had about £7,500 in there. And I was getting about probably 2% return on that over a year, which is obviously not really ideal. I would be looking for more than that, especially as there's obviously an inherent risk factor for doing that. So I broke down the pie. Basically, I sold all the shares in it and the rest of it whilst it was still at a profit. Not going to lie, it was quite nice having the daily dividends, but it isn't what kind of ticks my box. What I have done instead, though, is open an ARK innovation pie, which kind of mimics ARK Invest's sort of portfolio, not quite to the exact kind of thing that it does, but the lion's share of these companies are kind of tech driven, growth stocks, if you like. And that kind of shows already. I have a 5.23% return on that pie, which actually the £111 is about the same as the 1% that I had off of the £7,500. So what did I do with the rest of the money? Well, I made some other investments. If we just go over to the investment side of the app, you can see that pretty much all my holdings, bar Robinhood currently, are now over £1,000. So first of all, I made sure that they were all over 1,000, so that we just had a nice spread of things going on there. Bought a little bit more of Apple. I also put a fair chunk of that money into the S&P 500. I already had about £2,000 in there. The rest of it's just chucked into there. And one could argue that that is kind of much of the same as the pie, really, because it gives you a small dividend payment. It actually is currently giving me 2.65%. However, I do hold quite a lot of the S&P 500 in a Vanguard account, which is actually giving me about an 18% return over a sort of 3-year period. So I'm hoping that actually long term, this would, the S&P 500 will give me quite a healthy return. It also allowed me to spread some of that money into these more, likely to grow or growth stocks, whatever you want to call them. If you take something like AT&T, for example, you have a look at their share price. That is obviously, if you bought, say, back here in December 2019, $39, and it's now at $25. It's going to take some pretty rapid growth to get back there. even if you dollar cost average that, even back to here, so where it went down to $32, you're still not at the 25 it is at the moment. So the dividend that they pay probably would have only really, at best, put you back level. So you're not really making anything on your money. Again, if you take realty income, for example, it hasn't really got back to its peak before the kind of pandemic crash of about 80 odd dollars a share. And as you see, it goes up and down in peaks and troughs. If you then compare that to, say, something like even just American Express, I know that's a pretty boring company in most people's eyes. In fact, it also pays a dividend. But you have a look there. That is a pretty good growth to my mind after the pandemic. Now, I know they're in the kind of banking sector. So if you then say take, let's say Square, for example, obviously of late it's had a bit of a kind of trading sideways appearance, but even before the pandemic, up to kind of about here, 2018, it was kind of traveling quite nicely along, and then it's been sort of semi-flat until obviously the pandemic hit. I'm trying to pick on ones that are, perhaps not kind of rocketed to the moon. But even here, Apple, you can see, that's on a steady upward trend all the way here. Even in the pandemic, only really went down to $57, which takes you back to about September 2019. So from September 2019 to March 2020, so a 6-month period, if you'd have started investing in September, October 2019, when the pandemic hit, it just would have wiped out your gains at that moment in time. Obviously, there's lots of things, like I've got some investments in Coinbase. They've done incredibly well of late. Robinhood was doing quite well until I dollar cost averaged when I sold the pie. So yeah, all in all, pretty kind of good returns. One of the other things it was doing is it was bringing this 9.69% return, overall return, down quite a lot, because obviously I had what at the time was about a third of the portfolio in the pie, and that was giving a pretty pants return of about 1%, because it doesn't give you the kind of dividend return in this 9% here. I don't know if there's any way of displaying that or anything, but anyway, so yeah, that's pretty much it really. As I always say, I'm not a financial advisor, so don't just copy me. Just because I've given up on the dividend pie doesn't mean that you should, if that's your strategy. Everybody's strategy will be different. Some people will be happy with 2 or 3% return and a small dividend on a daily basis. It just depends what you want to get out of your portfolio. For example, when I am 65 years old and I'm fully retired and I'm sitting on a beach somewhere, I don't want to have the kind of emotional roller coaster of something like Robinhood or Coinbase, because it would probably give me a heart attack that one day I can't withdraw any money and the next day I've got shed loads of money. It's almost cryptocurrency style fluctuations. And again, PayPal, I've had some good returns on PayPal of late, and then it's just all suddenly gone down and so on. So even kind of household names fluctuate quite a bit. So don't listen to me particularly and take your advice from that. What I'm saying is that the reality is you need to do your own research. You need to look at that and make your own decisions. I'm just a guy on YouTube at the end of the day, talking to you about his portfolio and the decisions that I make. They're not necessarily right or wrong, and I don't think you should copy them, because everybody's decision is really of their personal circumstances and their risk appetite. Some people would say having a fair chunk of the portfolio in Lucid is probably not a good idea, but I believe in the company and it doesn't affect me if it goes down. It doesn't mean that I can't afford to pay my electricity bill. Well, soon it might do if the prices keep rising. Anyway, on that note, I will leave you there. If you could smash the like button, subscribe to the channel, comment below. Anybody else got a dividend pie? Anybody else made changes? That sort of thing. Really interested in learning about that. So yeah, please do feel free to comment below, and I shall see you next time.